The SEC just legalized the crypto stock market. The same thing it sued Binance for 3 years ago is finally getting the green light. Same conduct, new chair, the lane opened. Tokenization just stopped being a crypto story. 3 questions. What did the SEC actually permit? Who actually wins? And what changes for every wrapper, every token, every venue that has been operating offshore until now? The regulatory floor moved. 3 new decisions sit on every issuer's roadmap. We will get to them. First, what actually got published? On May 18, 2026, public reporting confirmed an innovation exemption framework under an initiative the SEC calls Project Crypto. Chair Paul Atkins has been signaling it for months. The document is landing now. The framework permits crypto-native trading venues to offer on-chain trading of U.S.-listed equities. Without full broker-dealer registration, without national exchange registration, under temporary guardrails. If you have been watching this channel, this story has a name. Robinhood asked for exactly this framework in April 2025. 13 months later, the SEC said yes. Here is what the exemption does. Imagine opening Coinbase next year. You see an Apple ticker next to your Bitcoin balance. You buy 50 shares. The token in your wallet is the share, not a derivative, not a synthetic wrapper, not a contract with the venue, the actual underlying share. Trading and settlement happen on-chain. The exemption sets exposure limits per investor, mandatory disclosures, and a custody standard. And it is time-boxed. The framework runs for 12 to 36 months while the SEC watches the experiment. The exemption is not the rule. The exemption is the lane. Now zoom out because the news is not just the framework. The news is who wrote it. The Atkins SEC is the same institution that brought enforcement against the exact structural setup 3 years ago. One venue handling trading, custody, and settlement without full registration. That was the violation. Project Crypto is the sanctioned pathway. In a 2025 speech, Commissioner Hester Pierce told the industry tokenization was enchanting, but not magical. A tokenized security is still a security. The new framework does not contradict that. It adds the lane. The principle did not change. The chair did. The lane opened. That is the message every venue that operated outside U.S. regulatory perimeter for the last cycle needs to read carefully. It is the most important thing the SEC has said about crypto in a decade. And it is not a regulatory reversal. It is a regulatory specification. The instinct is to read this as a crypto win. It is not. Look at who is moving in the same direction. DTCC is the central settlement infrastructure for the entire U.S. equity market. On May 4, 2026, DTCC announced a tokenization service. July is the pilot. October is full launch. The participants list reads like a roll call of the people who already run U.S. capital markets. BlackRock, Goldman Sachs, JP Morgan, Circle, Ondo Finance, Anchorage, BitGo. More than 50 firms across traditional finance and crypto-native infrastructure. The SEC framework is the customer-facing lane. DTCC is the settlement floor underneath it. Those 2 announcements are not independent. They are coordinated. Tokenization just stopped being a crypto story. Wall Street is the buyer. If the Atkins framework is right, an entire layer of the tokenization market just lost its reason to exist. Robinhood Europe, backed, X stocks. Every one of them is a derivative on top of a custody arrangement. The synthetic wrapper economy was offshore for a specific reason. The U.S. retail customer could not legally hold an actual on-chain U.S. share. So the workaround was a derivative contract that tracks the share. That product needs Lithuania. That product needs Robinhood Europe as the counterparty. Now the U.S. has a lane. The wrapper has to compete with the real thing. Wrappers were always a workaround. Workarounds end when the regulator opens the lane. Back to DTCC. Most people in the crypto industry do not think about DTCC because DTCC is not crypto. DTCC clears more value per day than every public blockchain combined, by orders of magnitude. The entire U.S. equity market settles through it. When DTCC turns on its tokenization service in October, Russell 1000 equities become settable as tokens. Major ETFs, U.S. Treasuries, NYSE and NASDAQ both have similar projects under development. This is not a single experiment. It is the entire industry deciding the rails move. And remember the trade the SEC is replacing. On May 13, 2026, a cluster of Solana tokens marketed as OpenAI and Anthropic equity crashed 40%. Both companies publicly disavowed. Nobody was authorized to issue those tokens. If the framework had existed 2 years earlier, that trade does not happen the same way. The exemption ties the token to the registered venue. The registered venue ties the share to the issuer. The issuer has the last word on what their equity is. 3 new decisions now sit on every issuer's roadmap that were not there before. 1. Onshore or offshore? Before this framework shipped, the answer was offshore by default. The US did not give you a lane. Now, you have to decide whether your product is more valuable as a US-registered on-chain share or as a foreign counterparty derivative contract. Different audiences, different cost stacks, different compliance regimes. 2. Real share or synthetic wrapper? If the venue can list the real underlying share, the wrapper has to justify itself on something other than regulatory access. Tax treatment, cross-border portability, 24/7 liquidity, embedded yield. The wrapper still has uses, but it is no longer the only path. 3. Whose registration do you ride? The exemption is granted to the venue, not the token. So, whose venue clears your product matters more than which chain you launch on. Coinbase, Kraken, an ATS, a national exchange? Each one changes the customer set, the marketing rights, and which regulator hears about your next problem first. Get those 3 decisions right, and you ship a real on-chain US equity product. Get them wrong, and you ship a wrapper that the next exemption retires. Our last episode closed on a backdoor. Robinhood found the backdoor to Wall Street through Europe. Now the SEC has opened the front door. Same building, same staircase, new paperwork. The story is US capital markets repapering themselves on-chain. The crypto industry is one of the rails. It is not the whole stack. Tokenization just stopped being a crypto story. The SEC absorbed it. The DTCC is building it. The exemption is time-boxed. The window is open. Every venue, every issuer, every protocol has to decide whether to spend the window onboarding to the new lane or arguing against it. The wrapper era ends quietly. The Rails era starts loudly. Pick which one you are building for. Subscribe so we can do this again next week. Tokenize Weekly, Episode 6.